Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Will the market bounce back and fill the gap? Can we bounce further from here? And the inflation data is still pretty worrisome. Interest rates broke out to the upside from their consolidating triangle. What do these things mean for gold? Let's take a look at the charts. At the time of this recording, it is midnight on Sunday evening, and currently the futures are up 15 points. So taking a look at the charts, I mentioned in the intro that the market did jump back and fill this gap. So where do we go from here? Well, if we take a look at the moving averages, you can see that we have recovered the 50-day moving average, sitting back on top of the 10-day moving average as well. We did get a negative cross with the 1030, but the 10-day moving average is trying to creep back to the upside. So can we go higher from here? Well, one thing to consider is we do have a qualified zigzag now to the downside. With this a potential impulse A wave, could be corrective move right to the 61.8% fib level, which would put our initial downward move at around 420. And then we've speculated that if we go that far, we're likely to continue all the way on down. Let's look at how this 161.8% extension would be right down here around that 400 level, which would also fill that gap. But another thing to consider is that we still haven't broken out of that one standard deviation channel that we've been showing you for a number of weeks now. So could the market go higher from here? Well, as you've heard me say in the past recordings, I feel that what happens with interest rates is going to tell us a lot as far as where the market goes from here. And you can see that clearly we've had an upward break with a confirmation day to the upside in interest rates. Now at this point, we are a little bit overbought. Some pretty good separation there between where the 10-year is and its 10-day moving average. So perhaps we get a little bit of a pause here in the jump in rates, but they definitely jump to the upside from this ascending triangle that we talked about, how the consolidating symmetrical triangle had morphed into an ascending triangle, and there's your upward break. But we're still just at a wave 4 corrective level that could say that we may have a 5-wave pattern to the downside, but much more of a break, and that will disqualify that downward 5-wave pattern. Some resistance lies up here around 15 on the 10-year. So again, perhaps we get a little bit of a pause in rates. Maybe that gives the market an opportunity to move back to the upside from here. How does this affect the dollar? Well, we take a look at the dollar, and the dollar has remained very strong right at the end of this zigzag pattern that we talked about in the last recording, and hovering right at that previous wave 5 high. So what's holding the dollar to the upside? Well, I also mentioned in the intro that the inflationary data is a bit worrisome. Well, here's the August PPI, the producer price index, which is wholesale prices. That's what producers pay. It increased 0.7% in August from a month ago, above the 0.6 estimate, which means final demand prices rose 8.3% from a year ago. That's the largest increase going back to 2010. The move showed that inflationary prices are likely to persist. No, that can't be. The Federal Reserve has been telling us that this inflationary stuff is transitory. It's not going to last. So how can it be persistent? Well, here's what really is concerning, in my opinion, with the inflationary data. So you can see 0.7 on the PPI, but when you take a look at the CPI, it only rose 0.3%, or 5.3%. from a year ago, both lower than expectations. So the PPI higher than expected, the CPI lower than expected. Well, what does that mean? Well, if the producers are paying more and not able to push those price increases onto the consumer, that hurts profits. So how long before that starts affecting quarterly earnings reports? Not too long, I wouldn't think. Oh, I forget the 3% increase. When we strip out food and energy, the core CPI, as they call it, ex food and energy, we were only up 0.1%. Because, you know, when you go to the grocery store or fill up your car, those don't count. Those don't really affect what you're spending on a monthly basis. Why would you count those in the CPI? Obviously, I'm being sarcastic here. I've never understood why we put up with the fact that they use the core CPI as a gauge when we spend money at the grocery store and at the gas pump. All right, well, getting back to the markets. So from here, those seem to be pretty supportive of the dollar staying strong. Well, what effect would that have on gold? Well, in the past, a lot of people have talked about how when interest rates go to the upside, then that can be a negative for gold. As interest rates go higher, gold tends to go lower. But it didn't work that way in the 70s, where we had really high interest rates, and that was a really good period of time for gold. So that doesn't seem to hold water. And then there's another viewpoint that gold prices move with inflationary data. But that doesn't seem to hold too much water either. I think the best correlation between gold and where the market moves from an economic standpoint is taking a look at the dollar. So a stronger dollar is going to make it tough on gold to go to the upside. So if the dollar can break through this resistance here and move higher, I think that means gold moves lower. But if the dollar does rest and peel back, possibly back down towards this previous floor, test that again. It already has once, so it doesn't have to. But if it was to do that, then I think we could see a bounce in gold. So my point is, I think gold is very dependent on what happens with the dollar from this point. I'm curious as to what you think about gold. Post a comment in the comments section. Where do you think gold goes from here? Does it go to the upside? Does it go back down to the downside? Be interested to hear your thoughts. Well, in the last recording, I mentioned that if we lost the SMH, because that's been one area that has stayed strong throughout this market, that the market was in trouble. Well, it did gap down, but note it's held this really nice set of higher lows. Pretty good uptrend here, right at a 45-degree angle, which I really like. In fact, you could draw a line with the higher highs as well. You got a pretty good channel moving to the upside there as well. The issue here is there's just not a lot of strength behind it. There hasn't been the whole time. So how long can the SMH continue to move to the upside with seemingly no strength behind it? The ADX was kind of going sideways, like non-committal, but on the last move to the upside, the ADX has even moved to the downside. So if we lose that, I think we're in pretty serious trouble as far as the markets, and then that downside correction could continue. Something that we've been looking at our Trade Finder meetings on Tuesday night. By the way, if you haven't attended a Trade Finder, I invite you to do so. It's every Tuesday night. It's free, 9 o'clock. We look at the markets. We look for trading ideas. You can register at our website at ewotrader.com or in the comments section underneath this video. Love to have you. But we have a lot of international viewers, and they've been asking about the India market, and that chart has been really strong. So you take a look at the Nifty here, and it's been moving to the upside quite nicely. We're in a wave 3, so could we go higher from here? Well, one concern is, if you've ever heard me do a recording before, you've likely heard me say that no security in any time frame gets very far away from the 10-day moving average. I use that 10-day moving average a lot to help with determining overbought, oversold conditions. Well, something else to look at along the same lines is the separation between the 10-day moving average, which is this lime green line, and the 50-day moving average, which is the royal blue line. Note that every time we start to gain some separation, the two come back together, just as a market comes back towards its 10-day moving average. So we get back here, start to gain a little separation, back we come. Now look where we are again on the Nifty, starting to gain some separation. So could it be a time that maybe the India market, the Nifty, starts to rest a little bit? I think that that's a distinct possibility. Not necessarily a big correction, but some sort of a pause to the move. And you take a look at the DMI, it's kind of non-committal. So there is some fodder here that maybe we could go a little bit higher. I just think that maybe a little caution if you're trading the India market at this point in time. Last but not least, as we always do, let's take a look at the VIX. Well, we did break out, so we definitely had a breakout from that long descending triangle that we had, but here we are, right back down, heading towards that 16 level again. Are we going to make it back down there? Are we just testing this breakout move? If we would have broken back to the upside on the VIX on Friday, would say, yeah, that was just a test of that trend line and that we were heading back to the upside. So the fact that we're back below it again and heading towards 16, and maybe the dollar pauses a little bit, inflationary data maybe takes a little bit. I mean, you could see that there could be a little bit more of a bounce to the upside, but I still go back to, we do have a qualified zigzag pattern, and that's where I put my trust until that pattern, or if that pattern becomes disqualified. Hope you found this informative. Hope you've had a great weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.